This was one of the stranger days that we've had on the S&P 500 in quite some time. The index closed up by 0.3% today, yet 65% of the stocks in the index closed lower. So in tonight's video, I'm going to show you some ratio charts and talk through some of the concepts as to why that's happening right now. But it has been dramatic and very strange, not something that we are used to. We'll also talk in tonight's video about what's been going on with some different commodities like gold. We're going to take a look at Bitcoin, which has really been outperforming here more recently. And we're going to see what all of that means in terms of postures, not just for the stock market, but also for the bond market. We'll also discover what currency movements have meant for the foreign bond market, and then we'll get into our trade application example where I wanted to feature a small cap gold stock that most people have never heard of before that's really breaking out in a big way right now that I thought we might try for a trend trade. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's March 23rd, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow us. My handle in particular is @BrandonVanZ. And we really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence over on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, I've got the S&P 500 heat map pulled up in front of us. And by looking at this, you might have assumed it was a bad day for the market. After all, we have way more red on the screen than green. But the truth is, the S&P 500 was actually up 0.3% today. So it wasn't even one of those where you just barely got above the break-even line. It was pretty noticeably in the green. We were up much more earlier in the day, to be fair, but it was still an advance for the overall S&P 500. And the reason behind that is because we've seen this theme play out over the last, let's call it, 3 weeks or so. I think it's since basically the beginning of March. In fact, I just got done posting this on Twitter here just a second ago, so I might as well refer to it. This theme right here, the S&P 500 itself was up 0.3%, but the SPY, which tracks it, was up 0.27% today. Yet 65% of the stocks within the index closed in the red. The reason? A continuation of the theme we've seen since the start of March. Small and mid-cap companies that are equal weighted within RSP are getting trounced by mega-cap tech. So remember, if you're looking for an equal weighted version of the S&P 500, you can use RSP as your ticker symbol there, whereas the normal market cap weighted S&P 500 that people are more familiar with, you can use SPY. So you can see here I've got this kind of ratio chart to show you how dramatic things have been in a very short amount of time. This is just a 3-month chart that you're looking at here, but basically it's the equal weighted S&P 500 divided by the market cap weighted S&P 500, and this thing has just completely fallen off the map here since the beginning of March. And that is a kind of a continuation of this theme that I posted last night here as well, which I retweeted based upon the tweet up above, where I posted about MAN. I don't know if anybody else has that acronym out there yet, but of course FANG had all of the press a few years back, and so just been thinking about some of the tech stocks that have been rocking it here recently, and Microsoft, Apple, and Nvidia are the first three that I think about, so you can easily put that together to come up with the acronym MAN, but in this case you can see how much better the S&P 500, how much better these three tech stocks have done than the S&P 500. This is also a 3-month chart that you're looking at here, and there's this dotted kind of gold line right here that will track the pathway of the S&P 500 over the last 3 months, and it's up, but just a little bit. Whereas if you added Microsoft, Apple, and Nvidia together to kind of create one single stock of those three, this is what that pathway would look like. And those things are just taking off. In fact, I think I heard them say on CNBC earlier today that Nvidia is in the midst of I think it was a 9-day win streak, and I think they said that was the longest continual win streak for NVIDIA since 2016. So we're talking many, many years back. So this is happening in the midst of what a lot of people feel like is a chaotic market environment. Some people would say we're in the midst of a doomed market in terms of the banking crisis that we're dealing with. Yet NVIDIA just keeps rocking it to the upside. It was up another 2.73% today. So, it's been really, really interesting to see, in particular, the AI theme play out this year. So you can see NVIDIA was up nicely. Microsoft was up nicely, about 2%. Apple was up about 0.7%. And then Alphabet over here also had a big day, up about 2%. So what we see here on this heat map are all 500 stocks within the S&P 500. And most of them are in the red, but most of them are the really tiny little, squares that you kind of have to hover over to see even who it is. Like in this case, it's Generac as a $6 billion company, right? Which is basically an afterthought in comparison to this size. So again, remember, Apple is the largest publicly traded company in the United States, so it has the most influence on the S&P 500. And then comparing that to something like this little sliver over here of Generac, it is basically an afterthought in terms of the difference it can make within the S&P 500. So as long as these big squares are pulling their weight, they can completely offset and mask the weakness that is taking place elsewhere. And I kind of get the sense that is happening to a large degree here for the last 3 weeks. I know even for myself, looking at my own portfolios, many of them, dividend companies that are much smaller in market cap, they're not doing nearly as well as those mega cap tech stocks out there. Those are the ones that are truly the workhorse of this market right now. So it's been interesting to see that theme develop and then continue. And it's the consistency of the theme that is, the most eye-opening, because it has been, kind of a one-way line for much of the month of March. We'll see if it can, push forward to the end of March, which we've got another week left. And then, of course, that'll be the end of the quarter as well. And it looks at this point like the S&P 500 will have closed higher for the first quarter of 2023, unless, of course, we get some sort of major crash next week. But right now, it's looking pretty good that we're going to get ourselves a positive quarter. And if you're wondering who to send your thank you notes to, you can address them to Cupertino, California, and perhaps up in Seattle, where Microsoft is headquartered. So point being, those are the big fish that are basically carrying this entire market on their shoulders right now. In terms of other big movers today, we did see Netflix have a heck of a day. It's not nearly as big as it once upon a time was, but still it's an impressive size at $142 billion. It was up 9% here today. Massive move out of Netflix. It was the leading stock in the entire S&P 500. And I think the reason behind that is they're starting to crack down on password sharing overseas, even in Canada. And some suggest that will be coming to the United States soon enough. So for all of you that might be sharing passwords of your Netflix accounts, you've been warned. In all likelihood, that will not be allowed at some point in the future. And therefore, the hope from the stock market, at least, is that will translate into new sales for Netflix from people who still want to maintain a subscription with Netflix but can no longer be on their parents' account or something like that. So anyway, looks like we had a nice robust rally there out of Netflix today as well. Also noticed that Regeneron had a very good day here. I noticed that was one of the best ones on the 9 at 9 this morning. Remember, if you're trying to get a quick and dirty way to get informed about what to expect out of the market on any given day, I would encourage you to check out my 9 at 9. It is free for everybody, so you don't need to be a premium member of Market Scholars to access it. But you can find it on our website under the blog area of our website, or you can just follow me on Twitter, and I post it on Twitter every morning right around 9 a.m. Eastern time as well. So it's in half an hour before the market opens to kind of give you a sense as to which stocks are likely to be moving in the market that day. And Regeneron, I believe, was the number one mover pre-market today and still managed to close within the top 5 of all best performers in the entire S&P 500 today on some positive drug news there. On the flip side, of course, there's plenty of bearishness out there, plenty of red and maroon squares and rectangles. One of them that catches my eye straight away is Schwab. I think I mentioned this, either Tuesday or last week. Can't remember exactly when it was, but you'll remember me saying that there's a little bit more nervousness when we're talking about Schwab here, right? All of a sudden, if it affects us personally, we're thinking, what's going on, right? A lot of us probably don't have banking accounts over at Silicon Valley Bank or Signature Bank or even First Republic. Some of you might, but most of us don't, and therefore that's somebody else's problem way over there, right? But many of us, including those of you listening to this video right now, have accounts at Schwab, not because we necessarily wanted them, but because we kind of got forced into it. And what I mean by that is, of course, many of you have followed David and I since our TD Ameritrade days, and TD Ameritrade, of course, has been bought out by Schwab. So Schwab continues to be a bit of a house of pain here. It was down about 6% here today in the normal session. Obviously still a large company at $96 billion, but there's definitely some concerns in the air. The company's done a good job coming out trying to relieve those concerns. And I tend to believe them personally, but then again, what do I know? I'm not a banking analyst, so you got to sometimes recognize that the market does its best to sniff out where there is legitimate risk, and the market's not usually tremendously wrong. It can be on a one-off occasion here or there, but more times than not, where there's smoke, there's fire. So we definitely want to keep our eye on what's going on with Schwab. Right now, I don't think there's anything that I would be particularly concerned with their brokerage side, which is what most of us care about. But I think the market is more concerned about their banking side, and their shareholders are paying a little bit of a price for that right now. So we'll keep our eye on that. But right now, it's down 6% here today, alongside many of these other regional banks that were also struggling today. There's Comerica, and so that stock was, I think, the worst stock in the S&P 500 today. It's only $5 billion these days, but it was down 8.5%. Many of these smaller banks have been blasted so dramatically in just 1 month's time that their market caps are no longer as relevant to be in the S&P 500. It's been a little astonishing. It wasn't so long ago that in my own mind I was, kind of stack ranking the S&P 500, and usually on the smaller market cap end of the scale, you were talking about kind of around $10 billion or maybe high single digits. But we're starting to see companies in the S&P 500 right now that have $5 billion or $4 billion, or I think with First Republic, when we looked at it the other day, it was like $3 billion. So we're talking about legitimate mid-cap, if not small-cap companies in the S&P 500 right now, not because they started that way, but that's just how it shook out, because the stocks are down like 50, 60, 70% in a month, and all of that market cap is just evaporating. So I am curious how the committee over at Standard & Poor's is going to be looking at this, and if there's going to be a major upheaval within the index here moving forward, if these banks can't recover fast enough and get some of that market cap back. So today was another one of those days where regional banks were front and center of the market's concerns. But they weren't alone. You can see pretty much all energy stocks were down today. In fact, I think, that was one of them that was up by just the smallest of margins. EQT was up 0.07%. Otherwise, it looks like all the rest of the energy stocks in the S&P 500 were down today. It looks like the vast majority of utilities were down as well. American Water Works was up just a smidge, and then that might have been it. I think in both the energy and the utility space, just one single component within each of those sectors was up within the S&P 500 today. So it was an onslaught of selling in both of those areas. In fact, a special shout out to those of you that are part of my factor-based swing trading class. You might have seen my Telegram note come through earlier today as we hit the proverbial easy button. Many of you know that I teach a swing trading class on Wednesday mornings, and every so often we hit it clean. In other words, we nail it exactly the way that we wanted to. And yesterday morning we did put on a short selling trade on NRG Energy, and wouldn't you know, just one day later we were shutting that down at max gain. So we had the benefit of a massive sell-off yesterday afternoon, combined with the utilities in general continuing to slump here today. So a rare instance where a swing trade where we expect to be in it for 3 weeks actually locked us down at max gain within just one single day, in and out, just the way that we like it. You can see that there was also some stress within the consumer staples area and also the real estate investment trusts. Those REITs have been just getting absolutely decimated here recently. REITs are a little bit of a hit and miss area when it comes to dividend growth investing, my specialty. The reason for that is not that REITs themselves are bad or anything like that. It's the structure of their investment type that makes them difficult for dividend growth investing, because many of you know that when a company chooses to become a REIT, they kind of sign on the bottom line with the IRS that they will pay out at least 90% of their net income, which effectively means the real estate investment trusts better see net income rising pretty much every single year. Otherwise, it will result in a dividend cut. And so we're starting to get into those dicier times now where it makes you wonder if we're going to start seeing a lot more dividend cut announcements out of the REITs, similar to what we saw back in 08, 09. We've already seen some out of the office REIT portion, but maybe that'll start working its way into some of the other themes within real estate as well. If it doesn't, then there's tremendous opportunity there. So obviously high risk, high reward in a case like that. But some of these REITs have been absolutely blitzed. Here's one of them as an example. Crown Castle, that's a cell phone tower REIT. That sucker has just gone straight down. The ticker symbol is CCI, and its yield these days is over 5%. I remember a few years ago when it had a 3.5% yield, we were impressed by that. But that price continues to go lower and lower and lower. So anyway, dicey times there in the REITs, dicey times there in the utilities. They're both interest rate sensitive, and so they probably didn't appreciate hearing from Jerome Powell with his desire to continue to raise interest rates here yesterday. All right, let's go ahead and pop on over to the main part of the platform, and wanted to show you the actual breadth numbers now. And as you can see, only 178 companies closed in the green today. So that was only 35% of stocks closed in the green today, despite the S&P 500 closing higher. That is a very oddball day, and what is required out of that type of an end number is for mega cap stocks, especially the mega cap tech ones, to outperform so dramatically that they more than offset the nearly 2-to-1 losers to gainers that would have happened in the smaller sectors that are out there. So that was quite fascinating, to say the least. But that is the evidence there in front of you. Only 178 stocks closed in the green today on a day when the S&P 500 was up pretty nicely. And out of that S&P 500 components, 320 of them closed in the red. So the vast majority of companies closed lower today, despite the S&P 500 itself that those companies make up closing higher. Strange indeed. All right, let's go ahead and pop on over here now to the main part of the platform, and let's do some analysis on our charts, starting here with chart 4B. And a reminder that this is a four-grid that will allow us to see the four major U.S. equity indices all at the same time, and it'll allow us to see which ones have a posture that is bearish versus bullish using the market forecast technical indicator that you can find on the Thinkorswim platform. These are 3-month daily charts, just to make sure we're all on the same page. So let's talk it through and see what we can learn. S&P 500, as I mentioned before, was up 0.3% today. Here's what the candle looked like. One of those kind of indecision types of candles. A bit of a inside day there, at least from the body's perspective. You can also see that we had large wick on top and a large wick on the bottom, and yet we kind of closed in the middle of that range with not a very dramatic end result of only 0.3% to the upside. So there was plenty of room for trading here today on both the upside and the downside, depending upon how nimble you were. But one of the things that is a little bit more concerning is that we have not yet been able to close above this 30-day moving average on the S&P 500, despite how strong those tech stocks have been. Here's Apple. Look at that chart. Looks like a thing of beauty. That's the most important chart in the entire stock market right there. And so that's why it's hard to say, hey, we're in some sort of a crisis mode when literally the most important stock looks like that. And then here's Microsoft. And it looks pretty strong as well. Very close to 3-month highs. In fact, they're closer to 6-month highs. And then here's NVIDIA. And as I mentioned before, this thing just doesn't know when to quit. Obviously, it will at some point, but this is quite the run that it's on. 1, 2, 3, 4, 5, 6, 7, 8, 9 days in a row to the upside for NVIDIA. We happen to own those stocks in our top-down trend trading class, and that class has not done as well as I would like it to have done, but at least we do have that exposure to Microsoft, Apple, and NVIDIA, and that is helping make up for some of the lousy stocks that we have elsewhere. So we're happy to have what we do, but it is just remarkable to think that some of the most important stocks in the market look like this. Picturesque. Yet we go back and we look at the S&P 500 itself, and it can't even get above its moving average. That is falling at this time. Notice the moving average has been red this entire time since back here, basically on March 6th, was the last time it was yellow, which basically means this entire red time here, which is pretty much the entire month of March, price has been below a falling moving average, meaning the path of least resistance is still to the downside for the S&P 500. You can see that the green line down below on the S&P 500 has flattened out here in the last couple of days. So if we do get a sell-off going into the weekend, which I believe was the case last Friday, again, I was out of town, but my memory serves me correctly. I think it was a pretty nasty day going into the weekend. Remember, when we get into more chaotic markets, that can be a bit of a theme where participants don't want to be holding stocks over the weekend because they're fearful of what news will come out and knock the market off course. Last week, of course, we had the Credit Suisse news, but who knows what sort of news we're going to have this week, right? So sometimes we get those sell-offs into the Friday closes whenever we get more chaotic market conditions. And if we do get one of those tomorrow, I have a feeling that there's a pretty decent chance that green line can roll over, and soon as tomorrow we might very well have a pink moving average there on S&P 500 here on chart 4B. So I'll let you know if that ends up being the case when I'm with you again next week. But right now, just be aware that's a strong possibility. If the market doesn't go down tomorrow, then there's a chance that it can kind of retain, the green background for now. But it is very, very precarious right now, right? You can even see it with your own eyes. Let me right-click and maximize this. You can see here that this green line clearly was going up during this time period. So no question, it should have been green background during that time. But right here, just visually, just look at where we're at from this candle to this candle, which is right here to right here. And that's about as flat as a board as it could possibly be. It must be by just the smallest of margins. In fact, for those of you that don't know, there's this little green number right here that I'm circling with my mouse. So for those of you that are premium members that have access to this chart 4B, look for this little green number right here that's right above the labels. It's kind of hard to spot, especially for those of you that might be colorblind, but it's right there. And so you should see it. And then if you come over here and you point at the actual green line itself, like I'm doing, if you go back and kind of glance up there with your eyes, you'll see that the reading from yesterday was 38.57. You can see that in the label, in the green label above the indicator right now, that it is 38.71 as of today. So we're not even talking a full point there. We're talking like point, let's see, what would it be? It looks like about 0.14 is how much it went up today. In other words, almost nothing, which means that momentum is slowing down. And if we do get a sell-off day tomorrow, there might be a little dip in that green line there, and that would turn the background color that dark pink once again, because remember, it won't even go to light pink since it's already below the chart's 50th percentile. It's at 38.71 right now. So if it went down to, let's say, 38.5 tomorrow, it would automatically go to this darker shade of pink in that case because it's below 50th percentile on the indicator itself. And, judging by how this chart looks, I don't think that's going to help the cause for the bulls, right? Right now, to my eye, it looks like the S&P 500 is struggling to retake that moving average, and it's pushing down and away from that falling moving average, which to me is more bearish, not bullish. And so that's not going to help in that regard if the background color also changes to that dark pink. In terms of the Dow Jones Industrial Average, it was only up 0.23% today. And here, by the way, is what that would look like because it's kind of leading the S&P 500 in that regard. So notice that today, that green line did slump over just a little bit. It's now at 25 and falling. Remember, on the market forecast technical indicator, the lower reversal zone is at 20. And so it's not in the lower reversal zone, but because it fell, it's falling between the upper and lower reversal zone, it is now considered bearish. And since it's below the 50th percentile, it's considered strongly bearish. So this is what the Dow looks like today, and that could very well be what the S&P 500 looks like starting tomorrow. Notice that the Dow continues to be our laggard through this move. Yes, you've had a rebound move off of these oversold cluster signals, which is fairly common, right? That's kind of the expectation. But like I always try to train you guys, just because we expect a little bit of a bounce from there does not necessarily mean that we expect a trend reversal. It's just a momentary kind of, letting the steam off type of a move, but usually doesn't amount to much and then rolls over once again and you stay in that same trend. And that's kind of how the Dow is playing out here. You had this reversion to the mean type of a move. Now you've started to roll over here once again, and it's looking like there's a decent chance that the Dow could take out its lows here if we get any sort of selling here in the short term. What's been interesting about this is note that on the tweet that I showed you there a moment ago, I very much specified mega cap tech for a reason. A lot of times when you guys follow me on Twitter, you'll see that the language that I use is important. I could have just said that mega cap is beating small and mid cap, but I wanted to make sure that I specified tech, not just mega cap, but tech specifically within mega cap. Because when you look at the Dow, that's where you generally find your mega cap stocks. That's where you're going to find Coca-Cola and Procter & Gamble and Johnson & Johnson, which, by the way, I just tweeted about there a moment ago as well. Some of you might have seen that Johnson & Johnson offered a 3% dividend yield for the first time since 2020 today. Remember, we have a sold put going on this right now. It does have apparently its third straight oversold weekly cluster. Now note, it's not in the blue zone where we would look at buying it for my dividend growth investing class. There it would need to get a yield of 3.07%, so we're not quite there, but we do have a 3% yield, or at least we did when I took this screenshot, and that was the first time since going back here to 2020 that we had that. We had it two different times that year. First during the initial sell-off in the March COVID time period, and then you had one more chance in the fall of 2020 to get it with a 3% yield, where it was kind of similar to where it's at right now, where it touched the 3% yield, but it didn't quite come down and get into the blue zone. Back here it did, and that's when we were buying some of it with our stink bids in my my dividend growth investing class. But this is one that has kind of followed this pathway very nicely over time, and you can see how often it has reacted with bullishness once it got into the blue zone. Obviously, there are no guarantees, but this is one that kind of has behaved itself from that perspective, and we're getting awfully close to entering that blue zone once again. But this is kind of case in point as to what I was trying to mention there a moment ago, talking about the Dow. the Johnson & Johnson stock here has basically just gone straight down since the beginning of the year, right? Here's your dotted gray line right here that represents the yearly crossover for the market. So this is when 2023 started, and Johnson & Johnson stock was right there, and it has gone basically down in a straight line ever since then. So J&J, of course, is a mega cap company as well, but it's not part of the cohort that is experiencing the outperformance that I was referencing on the other tweet. It's specifically the tech stocks like Apple, Microsoft, Nvidia. It's not the Johnson & Johnsons of the world. So it's been interesting to watch the Dow really struggle at a time when some people might assume this is a rally being led by megacap, which it is, but it just requires a little bit of further explaining as to what specific megacaps are leading the way. Remember, Nvidia is not in the Dow Jones Industrial Average, so its 9-day rally that it's carving out right now is not helping the Dow Jones in any which way. Anyway, let's go ahead and talk about the bottom two charts now. The NASDAQ composite was up 1.01% today. And of course, that is where you're going to find Apple, Microsoft, Nvidia, and Netflix. So it was our leader today, and it wasn't even particularly close. Right, the leadership was clearly within the NASDAQ by the tune of 3-1. Right, the next best index was the S&P 500. It was only up 0.3%. The NASDAQ was up over 1%, just barely, but still a very nice day, all things considered. And remember, that's not anything new. I was already mentioning on Tuesday how impressive the NASDAQ looked on that candle. Of course, it gave back that move yesterday, but point being, it was the only one at that time that was above its 30-day moving average. Not only that, but it easily cleared that prior resistance area on March 6th. So should we be surprised today, just a couple days later, when this one was the massive outperformer once again? No, because trends tend to hold until they don't. And right now we are in one of those types of trends. Now, it doesn't necessarily mean you're printing money when you're looking at the NASDAQ, because it to a degree suffers from some of the same things that the S&P 500 does. In other words, it's not only the Nvidias and the Microsofts and the Apples in the world that are dictating it. There are also smaller companies there that are not holding up as well. In fact, this might be kind of interesting. Let's change from the NASDAQ composite here for a second. And then change that instead to the QQQs. That is the NASDAQ 100. And those are the 100 biggest companies within the NASDAQ composite that are non-financial. And here this looks even better, because just yesterday, the Qs hit a multi-month high. And while we closed lower yesterday, today, of course, we had that nice move once again where it was up 1.19%. So the QQQ outperformed the NASDAQ composite, which both of them trounced the S&P 500. But if you're starting to hone specifically into the tech-oriented areas, that's where you're finding your outperformance. Let's now take a look at XLK, just to see how that looks today. And same thing, again, we're honing in further and further on that niche of mega cap tech outperformance. XLK was up 1.63% today and has a new multi-month closing high today. It was up a little bit higher on an intraday basis yesterday, but today it closed at, I think it's a 6-month plus closing high. Let's just take a look. 6 months is right here. Yep, so this is a 6-month high today on XLK. It won't be a yearly high, but we can go back, and take a look at the yearly chart here as well. And you can see that this high that we had today basically takes us back to this candle right here on August 25th. So pretty much half a year plus highs that we're looking at there. And we don't have very far to go to take out that high from the middle of August. That would be yet another milestone on the way to perhaps eventually getting to 52-week highs. And if there's one sector that can get us there, judging by what we see right now, it appears to be technology. So anyway, it has been nothing short of breathtaking to watch those mega cap tech stocks just roaring higher. Point being, the NASDAQ composite, $comp on the Thinkorswim platform, does have a strongly bullish posture. It is above its falling 30-day moving average in this particular case. And then last but not least, here's the Russell 2000 in the lower right. And similar conversation, the theme that we've seen play out since the beginning of March is small caps just getting trounced. And a big reason behind that is what I mentioned to you guys on Tuesday. There are tons of small financial companies within the Russell 2000, and they just cannot seem to get out of their own way right now. In fact, you are sitting at 3-month lows on the Russell 2000. Remember, it wasn't so long ago right here where the Russell 2000 was literally the leader within this market. And then how quickly that can evaporate once we have a banking crisis unfold when nobody was expecting it. So we did sell off so aggressively that we now have an oversold cluster signal as of today. So be aware that there could be some sort of a shorter term pop higher. It doesn't have to be, because obviously if we're talking about banking contagion, that is going to be more powerful than any technical indicator like an oversold cluster. But if we have kind of a more normal market environment that we're operating in here, there is the chance that we get some sort of a short-term pop in the Russell 2000. But as I mentioned before with the Dow Jones, don't assume that that will lead to some sort of a trend reversal and we're off to the races once again later on this year. We probably have some difficulties in front of us getting past this banking crisis, and that's going to affect the Russell 2000 pretty dramatically. You'll notice up at the above the chart that the Russell 2000 now has red labels across the board there, and that's the only one of these 4 indices that can make that claim. In other words, there is negative performance on a year-to-date basis, a 3-month basis, a 6-month basis, and a 1-year basis. None of the other charts can make that claim. So it was down 0.41% today. It was the only index that actually closed lower today, because remember, the Russell 2000 has 0 exposure to Apple, Microsoft, or Nvidia, and that's the only one of these 4 charts that can make that claim. Right? The Dow doesn't have Nvidia, but the Dow has Microsoft as an example, and of course that's the case with the S&P 500 as well. So the Russell's getting no love right now because it doesn't have that mega cap tech, which is pretty much the entire move of this market. It's on the back of mega cap tech. It's one of the more extraordinary things that you'll recognize out of this market right now. All right, let's go ahead and pop on over here to the internet. I always like to get a chance to say thank you to those of you that help support these presentations. Remember, they take a lot of time for David and I to do, and we're happy to do them as long as they are making an impact for you guys. And how you let us know that they're making an impact for you is by clicking like on Twitter. Of course, it's completely free to be on Twitter as long as you have an internet connection, which apparently you do. Otherwise, you wouldn't be listening to this right now, which is also on the internet. So each and every one of you listening right now has an equal opportunity to be part of Twitter, and each and every one of you has a free and equal opportunity to support us by clicking like as well. So as I always say, as long as we're up and over 100 likes, I'm happy to do a full-length video as I'm doing right now. We just barely got over that mark this last time around, but there was only 2 days there, and you guys did so good for me that the time before that I'm not too upset about that, right? 140 or 141 or whatever it was on Tuesday was amazing. So here we just barely got over the century mark, but that's good enough in my book. So let's go ahead and do some shout outs here. Let's go into the middle of the crop today. Thank you to Margie and to Ayakipa and to Paul and Evan and Vernon and Surendhar and Paul and Ray and BZ Japan and Irene and Jonathan and Pam and Dave and Thomas and Jeanette and Greg, Zika Fons and Austin, and we've got Ken and William and Easy and Michelle and Boss and Das and John and Stephen and Ken and Ash and Duncan and others. There's Craig and there's Arth. Can't get to all of you, but do like to send some shout outs your way. So thank you to all of you and everybody else who stepped up to the plate and took the 5 seconds out of your day saying, hey, we'd like you guys to do those videos every day if you can help it. And I'm willing to give you my 5 seconds of time by clicking like. So nice and easy for you. Either go to the top of my timeline, you'll find it there. Otherwise, you can also find the tweet in question in the description area of the YouTube video itself. You can also find it if you're watching this video right now on the Market Scholars website directly below the video. And you can also find it in the email that we send out to you in the little Twitter link listed towards the bottom of those emails. Let's also have a little chat here about the factor selector. This gets updated on Tuesday nights, so just be aware that this data is a couple of days stale by now. Of course, those of you that are premium members have access to it in real time, but kind of gives us a lay of the land as far as what sorts of movements we're seeing out of the markets here more recently. And quality remains at the top for the third straight week. And if you've been in my factor-based swing trading classes over the last year and a half or so, you will know exactly why that is the case. And the reason is, if you look at the quality ETFs these days, they have a fairly large allocation towards technology. Keep in mind that there are just 3 companies in the United States that have AAA balance sheets according to the credit rating agencies in the US. And those 3 companies are Apple, Microsoft, and Johnson & Johnson, if you're looking at the 3 different credit rating agencies of S&P, Fitch, and Moody's. So 2 of those 3, Apple and Microsoft, of course, are tech stocks. And so they are going to be mainstays within the quality ETFs. And if we're in a moment in time where the quality technology stocks are doing well, as I just showed you here a moment ago, of course that is the case right now, then quality as an entire factor is going to be doing better on a relative basis than the other factors that are out there. You can see as well, take a look at low size here. So as I mentioned when we were looking at the Russell 2000 a moment ago, it has been a stark contrast to where those low size stocks were just a month and a half ago when they were leading the market. And then a banking crisis occurred. And you can see how dramatically that has impacted low size, where they have gone down basically for 4 weeks in a row in a straight line. So not healthy momentum there whatsoever. And if they're not careful, they're going to work their way all the way to the bottom before it's all said and done. Speaking of the bottom, we did have a flip-flop on the number 5 and 6 positions. Value managed to bump up and over dividend yield at this moment, but they are neck and neck when we check those numbers underneath the hood. Both of them struggling a little bit right now for a variety of reasons, including the banking crisis and some of the difficulties in the oil patch as well. But remember, there's also a lot of interest rate sensitivity there, and so that's not really helping their cause either. So it's a little bit less convincing on the bottom, but it is very convincing right now that quality is by far and away the leading factor at this moment. All right, let's go ahead and get back on over here to the main part of the platform, and let's do some 12 grid analysis. And so we will take a look here at chart 5A to get us started. And let's start in the lower corners once again, since those are the areas that concern me as somebody who likes to participate in the stock market the most, because they have a lot of influence on the stock market. Let's talk about the Treasury yields to get things started here. Treasury yields have actually rolled over for the last couple of days, despite Jerome Powell raising interest rates. Now, these are the longer term yields here. Remember, he only has direct control over the shorter term yields. So there is, some differences in regards to what he has full control over. Nonetheless, oftentimes they kind of tend to follow each other along in the similar direction, but not always. And sometimes when you're seeing the 10-year yield rolling over as it is right now, that can be a concerning thing for the overall market, because it's basically telling you, in this instance, at least my interpretation of it, is that market participants are fearful that we will be heading into a recession later this year. And they're kind of front-running the Fed in a way, suggesting that they believe that the Fed will be cutting interest rates by the time this is all said and done, even though they're still in the midst of raising them right now. And so that's been kind of interesting to notice, because we didn't have a lot of that behavior last year. Remember, last year we had interest rates going up and up and up month after month after month after month. And in response, TLT and government bond prices were going lower and lower and lower and lower. Remember, last year was one of the worst years in history for bonds. I'm not trying to be dramatic when I say that. It's the truth. It was literally one of the worst years in history for the bond market. This year, it has not been that way at all. This year, bonds appear to me to be taking a leadership role in terms of collecting the safety trade, right? I think there's still a lot of fear in the stock market. And I think there's probably going to be less fear in the government bond market moving forward, especially now that market participants feel like we're getting close to the end of this interest rate hike cycle. Now, it's possible the market's wrong about that expectation, but right now that's kind of where their mind is at collectively. And so this could easily be a year where the bond market outperforms the stock market, even though both of them got trashed last year. So second straight day, interest rates rolled over. We do have the 10-year at 3.4% when it was all said and done, which, as you can see, is closer to the lows of the 3-month period of time than the highs. And of course, the opposite of that is government bonds are closer to their 3-month highs than lows. And you do see that within the last 2 days, we now have a green moving average on TLT, which tracks the long-term U.S. Treasury bonds. And that means prices above a rising moving average here all of a sudden. This is not a good trend, so I don't know if you should get too excited about it. But you've got to start a trend reversal somewhere, and I think there is a pretty decent chance we are seeing that kind of more difficult, painful experience right now. It feels painful because it's got these wide cuts both up and down, but a reminder of where TLT came from. So let's right click and maximize this and then show you a 1-year chart instead of a 3-month chart, and you'll see what I mean. Back here, it was basically just going straight down. We've now been carving out a sideways pathway, and I think that this is the possibility of us actually reversing. It's just that it's an ugly process in that transition. But it would not surprise me at all if TLT can start going to the upside, especially if there remains concerns about stocks in this market environment. I think TLT and government bonds can collect some of that money that would have been dedicated to stocks, especially now that interest rates are a lot more attractive than they would have been just a couple of years ago. And you could very well see stabilization here. It might not be the world's best trend ever or anything like that, but I do think that there's a chance that TLT outperforms the S&P 500 this year. Anyway, let's take a look here at the other bottom corner, in this case lower left, and that's the US dollar. It was up today, not by a lot, 0.14%, so a small move, but importantly, in the context of this other, more intermediate move here, this is basically an afterthought today. Sure, it's great that it was up finally after 1, 2, 3, 4, 5 days in a row to the downside, but you can see that was such a violent move lower in the US dollar that you have a red moving average now. And that I actually prefer for the stock market. And it's not really helping the stock market dramatically, but you can see that the S&P 500 has been up for the last couple of weeks after bottoming during that banking crisis, and at the same time the US dollar has been down. So it's not that there's no effect there, it just hasn't been tremendously obvious, I think, to a lot of us because of what I mentioned before. Most of the benefit of the stock market move has been going to mega cap tech, and so unless your account is all mega cap tech, you're starting to feel like it's still not particularly strong stock market out there. So, but the US dollar, if it continues to roll over, I think that helps things. It also helps foreign stocks. You can see up here, both foreign charts are now green, both EFA and EEM. Now they both had red moving averages, so it's not like we're throwing a parade for them, but they, at least on a posture basis, according to the market forecast, are doing better than the US markets. And part of the story there might be because the US dollar is rolling over. That benefits foreign securities, all else being equal. In fact, that carries through and translates to the bond market as well. In fact, BNDX, which is the ticker symbol we use as a proxy for foreign bonds, looks mighty good right now, right? This thing is on the verge of breaking out to the upside as we speak, whereas the U.S. government bonds have a ways to go to get up there, and we're a long ways away from a breakout on high-yield bonds in the U.S. But foreign bonds look like they could break out any moment now. So if the dollar does continue to roll over and you believe the bond market is going to outperform the stock market this year, but the falling US dollar could very well lead you into foreign bonds instead of into US bonds. So let's keep our eye on that theme as well. All of these bond categories have bullish postures. 2 of the 3 of them are above rising 30-day moving averages and have strongly bullish postures. when it comes to the foreign stocks, they don't look quite as good as foreign bonds, but there's at least some evidence of stabilization here. And both of them, as we speak, are flirting with the possibility of getting up and over those moving averages. It could happen as soon as tomorrow if we get an up day in the market. So obviously that's not guaranteed, but right now they're both sitting right on the moving averages. And so there's a little bit more separation between the S&P 500 and its moving average. While it touched it on an intraday basis, it settled a lot lower than that. So we shall see, but right now it's starting to give you the sense that maybe the foreign markets could be a place to start rotating some money into if you think this US dollar is breaking down in a major way. And I have no reason to believe it's not happening, right? We had an up day in the dollar today, but that wasn't enough to convince me that, hey, it's all fine and dandy now. This is still a pretty ugly chart here in the last few weeks, so be careful there with your dollar. You can see here that the Bitcoin chart continues to impress. And what's really interesting about Bitcoin off to the right-hand side here, it is up here at over $28,000 again. Yesterday, it got hit pretty hard. I think it was down $1,000 from its high yesterday when the whole market was kind of struggling with the whole interest rate decision. And so, you know, it made you wonder if it was getting a little bit toppy there and would give back some of those recent gains. But to have it roar right back here today has been impressive. Remember, Bitcoin tends to follow tech stocks pretty well, or vice versa. Who knows if it's the tail leading the dog or the opposite. But they both do tend to move in unison with one another. And Bitcoin is off to the races here and actually touched 29,000 or really close to 29,000 earlier in the session. But still, to basically make up all of yesterday's losses, which looked pretty good or pretty bad on the surface, just in one day, was pretty impressive. So, you know, don't just throw away Bitcoin because you're hearing all this stuff about, you know, FTX and these other scandals, and, you know, there's a lot of garbage and fraud and junk that's going through the cryptocurrency universe right now. But the stalwart of the group is Bitcoin, and it is firming up quite nicely here. It's quite the trend that we are witnessing. All right, let's go ahead and now take a look here at our sectors, and that'll be chart 5C. And as we pull this up here, a reminder that the background colors of these charts, when they're green, means we have a bullish posture. When they're red, it means we have a bearish posture. So at the moment, we have just 3 green charts, and they are 3 sectors that you guys hear me talk about fairly regularly: communications, technology, and discretionary. And you've heard me say in the past that if I had a magic wand and I could just somehow make it so that there would be 3 leading sectors, those are the exact 3 that I would pick. Not because it would benefit me personally. If that were the case, I would wave the magic wand over the consumer staples as a dividend growth investor. But I'm just saying, if you want a healthy market, then you want to be led by the growth areas of the market. Not necessarily the cyclicals, not necessarily the defensives, but specifically the growth compounders. And that's where we're going to find those areas for the most part, right? In communications, that's where you've got Alphabet and Meta. In technology, that's where you've got Apple and Microsoft. And in discretionary, that's where you've got Amazon and Tesla. And those are incredibly important stocks in today's market, in this current era that we find ourselves in. So that's the good news. All 3 of those charts are green. Of course, you can see discretionary is light green, meaning it's weakly bullish, whereas these other 2, communications and technology, are dark green, meaning that we've got strongly bullish postures there. You'll also notice that the only 2 charts that are trading above their moving averages right now are communications and technology. All the rest of the charts are trading below the moving average. So obviously that's not a great sign, but if there were 2 stocks that are 2 charts that you wanted to hold up better than others, those are a couple of them up there. So they're doing their best to just carry this market for all of the other lousy stocks that are out there. You will notice that every other chart is not just pink, but dark pink, meaning that all of the other charts you see have a strongly bearish posture, not just a weakly bearish posture. So that's not a very good look, and it's kind of odd when you see this, right? A lot of times, if you have a mix, and let's say you have most of the charts dark pink like this, then All of the others that exist would be light green, telling you that you've got some weekly bullish ones trying to get started. This is kind of a weird market, and again, a bifurcated market where you've got tech just launching to the upside at the exact same time you are seeing like financials and other things just torpedoing lower. Usually it doesn't work out that way. It's very strange market that we find ourselves in right now. But these other charts pretty much look like death, right? They look terrible across the board. In fact, so terrible that real estate and financials both ended the day with oversold cluster signals on daily candle charts. So a reminder, if you right click on these 12 grids, if you're a premium member of Market Scholars and you have access to this, right click on the 12 grid and then maximize the sell, you will be able to see the market forecast technical indicator down below to verify with your own eyes that right now on XLRE for real estate, we have green, blue, and red lines all below 20 on the same day to plot that little dot there and the corresponding one up above. And similar to what I had mentioned before, just because you're getting a cluster doesn't mean that all of a sudden this is going to go into an uptrend, but it could very well mean that the worst part of the selling is over and you're due for some sort of either stabilization in the chart or maybe even a pop back higher for a brief amount of time, but that the current downtrend is more likely than not to kind of continue to hold. So, both good and bad news depending upon your perspective there. But it is true that most of these charts look pretty terrible, but the ones that are looking good are the most important ones for a lot of market participants. So there's a little bit of an offsetting effect taking place there. In terms of which was the best sector today, no surprise, it was technology, up 1.63%, but communications was not that far behind it because remember, that's where you're going to find Netflix. So XLC was up 1.62%, just by the smallest of margins underperformed technology. Those were the only two sectors that closed in the green today. So think about that for a second as well. The S&P 500 was up today. It was in the green, yet 9 out of 11 sectors closed in the red. That is very, very peculiar. 9 out of 11 sectors lower today, yet the market was up because 2 out of those 11 sectors were really important from a market cap perspective where you have some of your biggest mega cap tech-oriented companies. In terms of who the worst performing sector was today, I think it was probably energy. Yeah, it looks like it was. Energy was down 1.39% here today. Not too far behind it was utilities, down 1.03% today. Remember, those were the two that I showed you on the heat map, that each of those had just one single component within them in the green today. Otherwise, it was an avalanche of selling within both of those categories. So no surprise, they took the most heat here today. All right, let's now get into our trade application for the day. And one thing that has been catching my eye, I should have probably brought this up actually. Let me go back to the 12 grid real quick here. Usually I talk about gold, but for some reason my mind went elsewhere there for a second here today. But let's start the conversation because that will kind of lead us into our trade application example. Notice gold. That thing just took off the last couple of days. In fact, we are up here so high that you're getting an overbought cluster signal there, right? It's been acting very similarly to Bitcoin. When there's chaos in traditional banking, sometimes money drifts away from that to alternative assets like gold and Bitcoin, and that's kind of what we're recognizing right now. So gold is hitting multi-month highs, obviously has a strongly bullish posture, is trading above its rising moving average and has easily cleared above the prior resistance area there. So it's been a volatile experience for sure because you had this really ugly, sell-off here in the midst of it, but we're back into the bullish trading once again on gold. So I went out of my way to look at the gold mining stocks here today to see if I could find a chart that I could, feel comfortable with. And the challenge is there's just not a lot of gold mining charts out there. There's only a handful of large cap gold stocks that we can access in the United States. And there's a lot more small cap companies out there. But even there, it's not like the biotech world where you have hundreds of companies to choose from, or the banks where you have hundreds of companies to choose from. You are fairly limited within gold. By the way, if you're looking for that, you can come over here to the quotes area of Market Watch tab, and you can click the drop down of whatever watch list you're looking at right now. And if you go down to buy industry, you can come over here to materials and then come over here to metals and mining, and then you can specifically choose gold. Now be aware when you pull that up, you're going to see dozens of companies that no longer exist because for whatever reason, Thinkorswim does not upkeep their watch list very well from that regard, but you can sort it by the last price to get to the ones that are traded. There's only a couple dozen of them out there, but there was one that certainly caught my eye today. I'm going to pull up a trend trading chart for this. I don't do this very often in this particular presentation because oftentimes trend trading can chew up a lot of my capital, and since this is an active trading account for this presentation that we do multiple times per week, we have to be able to free up buying power quite regularly. So I can't really afford to have a bunch of longer term buy and hold stocks or even longer term trend trades. But in this case, I thought, you know what, let's mix it up and let's see what happens here. This is actually a company that's very, very small, so be very careful with it. It's one that I actually hadn't heard of before. But as I was going through all the gold stocks, it caught my eye for obvious reasons as I pull up this chart here. This is Fortitude Gold, ticker symbol FTCO. And as you can see, it started breaking out above this prior resistance area back here in January earlier this week and really just blew it out of the water here today. Now, this is a good example of why it's important for those of you that are premium members of Market Scholars to tap into the Telegram channel that David and I use, because we send out our trade alerts for the video while the market is still open. And that way you have an informational edge over everybody else who's just watching the video for free on YouTube. And this is an example of a day where that really helped us, because as I come over here to the trade tab, you can see that I got filled at $6.99 and the stock ended up ramping into the close at $7.23, and so I'm already up by 3.5% at this point. And remember, I only took that trade with 20 minutes to go until the closing bell. And so it's not like, I got in really early in the day or something like that. That was 20 minutes before the closing bell, and now I'm already up 3.5%. But let's also make sure that we all recognize this is a very low price stock. It's only $7.23. And so a 3.5% move on a $7 stock, that could be gone with a snap of the fingers, within 15 minutes tomorrow morning. But hey, if you're asking me, would I rather start off on the right foot or the wrong foot? I will choose the right foot, even if it's 3.5%. Every little bit counts in this business. So it was nice to see a renewed rally in the last 20 minutes of the session, and we basically closed at the high of this candle. You'll notice down below that on the relative strength line, it scores a perfect 99. In other words, it is one of the strongest stocks when compared to the S&P 500 out there. Of course, this is a very, very small company. So again, buyer beware on that. I don't usually bring up these small cap, single digit companies, but I thought that the chart was interesting enough for me in this case that I'm willing to do it here. But I will give you that disclaimer and that disclosure out there that all of you should handle this one with caution, because it is not a very liquid security, and therefore you can expect a lot of volatility one way or another. But certainly have a chart that's breaking out here, and on this trend trading chart, you can see we're kind of in this green territory right now, which means that we have 5 green arrows on it, and that includes this arrow right here, this arrow right here on the war score, this arrow right here on the MACD histogram, this arrow right here on the stochastic, this arrow down here on the market forecast technical indicator. So, we're all kind of in alignment at this moment in time with bullishness kind of emerging from this chart. But because it had bounced off the moving average earlier this week, I didn't want to do a normal swing trade. A lot of times when I just do the common stock in these market outlook related trade applications, I will do swing trades. But in this case, it had already bounced so much that I didn't feel quite as comfortable doing a swing trade here. So I said, well, let's just mix it up here. Let's actually do a trend trade. Remember, I do trend trading in my Monday morning class for my premium members. So it's not atypical for me to do any trend trades, but it is atypical for me to do trend trades in this market outlook category because I can't chew up too much buying power. But in this case, since it's a smaller price stock, we're just going to take a flyer on it and see what happens. If gold keeps on rallying strongly because we find ourselves in the midst of a huge banking crisis, then maybe this is one of those, lottery ticket scratchers that you can have out there that can do pretty well. What I ended up doing, as you can see, this says TRSTP. It's a trailing stop. And what I'm doing in this case is I'm trailing it with a $1 stop. That's a really wide stop on a $7 stock, right? Percentage-wise, that's massive. But because it's a small cap that is illiquid, it's probably going to move around a lot more. So you couldn't just apply like a 10-cent trailing stop to it. Otherwise, you'd basically be stopped out pretty much immediately. So this one, you have to kind of give yourself a bit more room on that as well. So I'm using a $1 stop, not necessarily because that's the perfect number or anything like that. Maybe I'm just being lazy with a round number there. But you can see where that is right now, and it kind of crosses through a lot of this congestion zone over here. So my hope is that if it does roll over in the short term, it can find a bounce at the top of that congestion zone and then bounce back higher before stopping me out. So, I'm casting a pretty wide stop loss on this one, but because it's a trailing stop, it basically means it will continue to move it higher. Remember, I got in at 699, so at that time, the trailing stop would have been at 599, but because it went up to 724 by the close, then that pulls my trailing stop up to 624. So it continues to chase it higher as the stock goes higher, but it will never go lower as the stock goes lower. So this will be the lowest level it will be from here forward until I get stopped out at whatever time down the road. And remember, I could very well pull the plug on this trade later on down the line. And if I do, I'll let you guys know in the Telegram channel, those of you that are premium members there as well. But I figured, you know what, if gold starts working here, let's see if we can find something to work for us. You guys know that I did the new mining trade a couple months ago that worked out pretty well for us with a bull put spread. But this time we're going to go way down the chain in terms of risk and looking at a highly speculative small cap gold company. It actually pays monthly dividends as well, but that's not the reason I'm getting into it. The reason I'm getting into it in this case is the trend, but those little dividend payments could be a nice little cherry on top of this one as well. So let's see what happens with a small cap gold company in this case. Maybe, just maybe, if gold can get revving higher here, this is the type of company that could have some big upside in front of it. Okay, so that's what I had for you here today. If you enjoyed that presentation, if you got value out of learning about a brand new company that many of you have probably never heard of before, like Fortitude Gold, and if you want me to start exploring some of those darker corners of the market again in the future, there's one way to say thank you to me, and that is clicking like on Twitter. As long as we're up and over 100 likes by the time I'm scheduled to do the video again on Tuesday, I'll be happy to give you another full-length video like this one that includes a trade application example. On the other hand, if you prefer the shorter videos of only 15 minutes in length with no trade application examples, then don't click like. And if we're under 100 likes, then I'll just plan on doing a quick and easy one there for you on Tuesday. So we'll let you guys decide collectively. But whatever you decide, I appreciate you checking out tonight's video. I hope you enjoy the college basketball that will be taking place for the next 4 days as well. I know I will. And then I'll see y'all early next week. So until then, best of success with your trades and your investments. Goodbye for now.